pretty major changes as it relates to alternative minimum tax. And I know probably a lot of you out there, it depends how closely you look at the tax returns when we give them to you. But a lot of you are probably in an alternative minimum tax situation, and maybe didn't even know it. Not that there's anything, obviously we do everything we can to avoid it, but in certain situations, or a lot of situations I should say, it was just completely unavoidable. But this is some pretty big change that made its way through on this. And the biggest item you'll see there, you just follow the joint schedule there. The exemption has gone up, which is great, but really the item that's most significant is this phase-out threshold, where taxpayers previously, once they reached over $164,100, were starting to lose the exemption that was there. Well, now that phase-out is at $1 million. So bottom line on this is, as I see it, very few taxpayers are going to get hit with the alternative minimum tax. I say that, and I'm sure there's an exception out there, for some kind of unusual adjustment. But for the most part, we just should not see many of our clients paying alternative minimum tax anymore. You couple that with some of the other adjustments we've talked about with lost itemized deductions, and it's hard for me to imagine that being the case. Okay, so we have also an enhanced child tax credit as part of this legislation. Child tax credit has increased from $1,000 to $2,000 per child. The age limit, or the age ceiling on that, has not changed, so it's still for kids under age 17. The refundable portion has increased from $1,000 to $1,400. I think if you recall, that was the one where Marco Rubio was really kind of drawing a line in the sand, and I think it even at one point threatened to not follow the other Republicans on this bill, and eventually they agreed upon $1,400. I think he wanted it to be closer to $2,000, but ultimately settled at $1,400. There's also a new non-refundable credit of $500 for non-child dependents. So that would be for, example, parents living with the taxpayer, and assuming the other requirements are met, there could be a credit available there. Going back really quick on the refundable portion, a lot of people sometimes ask this, well, the refundable portion of these credits would apply to individuals who otherwise don't have a tax liability. So even though their income may be at a certain level where they don't owe any tax, but they still have qualifying kids, they would still be eligible to get some of these credits. The last item for these credits is the phase out, which has seen significant change. Similar to alternative minimum tax, where there was a huge increase in the phase out, seeing something similar, in my opinion, as it relates to child tax credits. So under prior law, you were looking at joint taxpayers, once their income exceeded $110,000, they started to lose the benefit of these credits. Well, now under the new act, we're looking at $400,000. So that's going to be a significant increase, and a lot more taxpayers are going to be getting those credits. Okay, so now we've covered some of the changes to income deductions, the rates, etc. Let's take a look at a few examples to get a better visual of what this might look like. So try to make some really simple examples here, but I think that hopefully either yourself or some folks that you can kind of apply this to and just give some thoughts. So first example here, we'd be looking at married taxpayers with 2 kids, both under age 17. They have wages and other income, $150,000. Deductions start with state income and property taxes of $18,000, mortgage interest of $8,000, and charitable contributions of $5,000. So the total deductions there, $31,000. So on the left-hand side of the schedule is the tax calculation under prior law. So we'd have adjusted gross income of $150,000. We have allowable itemized deductions of $31,000, which exceed the standard deduction in place of $12,600. So that's why you see the strike through there. We either get the itemized or we get the standard deduction. Don't get both, the greater of the two. So we take $31,000, and personal exemptions still available under the prior law would have been $16,200. So doing the math, we would have taxable income of $102,800, resulting in a tax liability of $17,243. So then if we layer that on to apply some of those items to the new law, adjusted gross income is not going to change. Allowable itemized deductions that we've stricken through there, $23,000. You say, well, why is it $23,000 under the new law versus $31,000 under the old law? Again, our state income and property taxes are limited to $10,000. So even though we have $18,000 listed up there, we're not going to get benefit for $8,000 of those. So we had $10,000 for our state income and property taxes, $8,000 for the mortgage interest, $5,000 for the charitables. So the most we could get out of itemized deductions is $23,000. Well, in this example, like we talked about earlier, so we said we're going to see fewer taxpayers itemizing, and this is a perfect example of $24,000 standard deduction. So we're clearly going to take the greater of the two. That leaves us with taxable income $126,000. Now you kind of look at between the new law and the prior law, taxable income is quite a bit more. We have a tax before credits of $19,599, and in this case, we do get the child tax credit, again, as a result of the increase in the phase-out up to $400,000. So they get full credit, or full benefit for those credits, where under the old law, they would not have received anything because of the phase-outs. So bottom line is, in this situation, we would have a tax reduction of about $1,644. Something to note on this example, though, okay, that's great for this particular taxpayer. They get some benefit out of this. If those two kids were 17 years of age or older, those credits go away, and they would be in a situation where they're actually paying $2,400 more in tax, roughly. So, like I said, it just depends on the fact pattern. For the most part, you're going to see folks doing better under this bill, but there are certainly situations where that might not always be the case. Okay, so I'll move on to another example here and just change the facts a little bit here and show a little bit more income. So again, married taxpayer, 2 children, both again under 17 years of age. Now, wages are now up to $500,000, and our deductions have been increased accordingly, okay? So obviously there's going to be more state income, assuming they have a little nicer house, more property taxes, etc., more interest, and a little bit more in charitable deductions. So under prior law, again, adjusted gross income would be our $500,000. Allowable itemized deductions, even though we have $72,000 of total itemized deductions, again, under those old rules, we start to lose some once our income exceeds around that $315,000 level. So we're only going to get $66,339 out of $72,000, leaving us taxable income of about $433,000 for a tax liability of $129,121. We'll layer that same fact pattern over to the new law, and again, allowable itemized deductions are only going to be $37,000. So why is that? We had $72,000 to start with, and we're down to $37,000. It all relates to, out of that state income tax and property tax deduction where we paid $45,000, we're only going to deduct $10,000 of that. That's our cap. So $10,000, $12,000, and $15,000 gives us our total of $37,000, and taxable income goes to $463,000. Tax liability, $115,679. So, fairly decent amount of savings there, $13,442 in that example. And a lot of that, the details aren't in the prior law tax calculation, but part of that tax under the prior law was related to the alternative minimum tax. So having that alternative minimum tax go away as well provided some really nice savings for this particular taxpayer. We'll just do a couple more really quick now to kind of put the facts out there. We'll just again really tick it up a bit, and getting us to again a married couple with 2 children. No changes there, but our wages are up to $1,500,000. So this would be really a high net worth individual or taxpayer, and the deductions would creep up accordingly as well. So under the prior law, again, you're losing more of those itemized deductions. We have $198,000 to start with, and the only amounts we could get deductions or utilization for would be $162,000. So there's quite a bit lost there. Bottom line is we would have a tax liability of $486,165. Layer that over to the new law. Even though we're losing a significant amount of deductions there, we go from having $198,000 in total deductions available up above to, by the time we run that through and limit our state income tax deduction, we're at $78,000. So you compare the two, obviously taxable income is quite a bit higher under the new law, which I think it will be in most cases, but our tax at the end of the day is lower, and we have a tax savings of about $9,400 roughly there. So as I mentioned earlier, as you start to get your income in those higher brackets, you do start to see some scaling back of the tax savings. And in this case, somebody who was at $500,000 of income had a greater had more tax relief dollar for dollar than somebody at $1.5 million. And really it comes down to those lost deductions at the end of the day, and you start to really see the cost of losing some of those deductions. But at the end of the day, again, it's somebody who's done better off under the new law than they were under the old law. Last example, I'm sure we all know folks in this situation, married taxpayer. In this case, I put 3 children in there. Under that scenario, if they have state income taxes, $10,000, and mortgage interest, $7,000, charitable contributions, $3,000. Bottom line is here at the end of the day, when you run it through, they would receive a tax reduction of about $2,300. So, for the most part, I've given you 4 examples here for various income levels, and not too complicated of things going on, but I think are pretty common. And you'll see, as you saw, there was some tax benefit in each one. So that just gives you a little bit of a visual of how the challenge is. We have our clients ask us a lot of times, well, hey, what is this new tax law? Am I going to save money? Is it going to cost me? There's a lot of moving pieces, as you can see, between losing deductions. There's new deductions available. Jane is going to talk about, obviously, some of the new business law changes. But it's at the end of the day, it's really having to run the numbers in order to determine what that is, because there just is a lot of moving pieces, and everybody's facts and circumstances are going to be somewhat different. So with that, turn it over to Jana here to get into the estate tax and some of the business tax provisions.